Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Amentum Holdings, ticker AMTM, the newly public government technology leader that resulted from a landmark merger and spinoff. And here is the core argument we need to test across all the source material you've shared with us. Amentum is a newly independent, pure-play government technology leader, currently executing a high-stakes repair and pivot strategy following its massive merger with Jacobs Critical Mission Solutions and Cyber and Intelligence units. The core investment opportunity, we believe, lies in a significant valuation dislocation, specifically trading at a 50% discount to peers like Leidos, masking its market-leading and arguably indispensable exposure to the global nuclear renaissance and critical space infrastructure.
That is quite the mission statement, and it's a really complex one to unpack.
It is.
For you, the listener, I think the first thing to get your head around is just how Amentum even came to be. It wasn't a simple IPO.
No.
We're talking about a business that finalized its current form through a massive and very complex transaction. It's called a Reverse Morris Trust, or RMT, that just closed back in September of 2024.
So this was a corporate divorce, really.
Yeah.
It took the legacy Amentum, which, was owned by private equity firms, American Securities, and Lindsay Goldberg, and smashed it together with Jacobs' huge critical mission solutions business.
The CMS business, yeah, plus their cyber and intelligence unit. So it was more than a divorce. I'd call it a complete corporate reconstruction.
Right.
It created this massive new entity. I mean, it's a behemoth in the government services space, generating, about $14.4 billion in annual revenue as of a fiscal year 25.
A huge number.
And our mission today is really to figure out if the market is punishing this company for let's call it the operational messiness of a huge merger.
Or if the market just hasn't seen the strategic clarity that's kind of hiding under all that complexity.
Okay. Exactly. Is the short-term difficulty of stitching these two giants together just obscuring this really clear alignment with some powerful long-term global trends?
That makes perfect sense. Let's jump right in and dissect the business itself. So let's unpack this repair and pivot strategy. It seems like that phrase dictates every single move Amentum is making right now.
It does.
Management talks about leveraging the broad enterprise of Amentum with a two-pronged strategy. How do we break those two prongs down?
Essentially, you can think of it as a two-speed company. That's the easiest way. On one hand, you've got this vast foundational core that's the stable engine. It provides all the financial muscle.
Okay.
Then on the other side, you have these focused accelerating growth markets. They're smaller, but they're engineered for really high growth and critically for margin expansion. That balances the whole story. And we can actually put some numbers on that split. About $10 billion of that $14.4 billion in revenue. So, roughly 70%. That comes from what they call the core growth areas.
Right, the defensive foundation.
Exactly. This is what gives the company its stability.
Defensive foundation.
Yeah.
That sounds like the steady, reliable work, the kind of stuff that keeps the lights on, keeps cash flowing, and sort of insulates them from the broader economy.
That's it.
But is this where the market still sees the old Amentum? The low-margin logistics player from its private equity days.
That's exactly the perception they are fighting. And while, these areas are defined by multi-year, sometimes multi-decade government programs that give them that dependable cash flow, the work itself is just far more technologically sophisticated today than, old-school maintenance contracts.
So give us the scope of that $10 billion piece. What specific sectors are we talking about?
We're talking about their core, long-standing leadership positions. It's across several critical defense and intel functions.
Like what?
So this includes research, development, test and evaluation, or RDT&E. That's basically the government's outsourced innovation lab. They also manage intelligence operations and analysis, homeland security, border protection, and then the huge ones: environmental remediation and defense engineering, logistics, and modernization.
Man, RDT&E, just so everyone's clear, that's where the U.S. government invests in what's next, right? Not just maintaining what they already have.
Precisely. And Amentum acts as the technical partner that helps the government prototype, refine, and then deploy new solutions much more quickly.
Right.
A really fantastic example of this kind of mission-critical work is happening in the Indo-Pacific region, which, as we all know, is a huge strategic focus for U.S. defense spending right now.
So let's look at that example, the ITEAMS program in Indo-Pacific.
Okay, so the I-Teams program is absolutely central to strengthening C5ISR capabilities.
C5ISR, that's a mouthful.
It is. It's command, control, communications, computers, cyber, intelligence, surveillance, and reconnaissance.
Everything.
Pretty much everything for the U.S. Armed Forces. And Amentum's role here is highly sophisticated. They're using things like rapid prototyping and digital engineering to just accelerate the speed at which new tech goes from the drawing board into the field.
So they're integrating brand new tech into existing older systems, which has to be harder than just building something from scratch.
It's way harder. They're acting as the deep systems integrator, using model-based engineering to predict how all these complex systems will interact with each other before you even build them.
That makes sense.
And you can see it in their support for the Naval Surface Warfare Center at Crane. Amentum is integrating next-gen sensors. They're applying that same model-based systems engineering for better lifecycle management.
So this isn't just maintenance. It's about extending the life and the capabilities of these incredibly complex, incredibly expensive naval assets.
You've got it. These examples just prove that even their stable core is deeply technical and engineering heavy. It really undermines that old critique of them just doing commoditized logistics.
Yeah.
Okay, so now let's pivot to the accelerator part of the business. This brings us to the accelerating growth markets. Now, they're only about $4 billion of the total $14.4 billion business today.
A much smaller piece.
A smaller piece. But this is the future engine for their margin expansion.
And these are the markets where the strategic genius of the merger really becomes clear. We're talking about three pillars: space, critical digital infrastructure, and of course, nuclear energy.
That's exactly right. Those three sectors, space systems, critical digital infrastructure, and global nuclear energy, they're all targeted for faster growth, and this is the important part, significant margin accretion.
Why?
Because of the incredibly high barriers to entry and the specialized technical knowledge that's required to even play in those fields.
Okay, before we dive into the huge topics of nuclear and space in the next section, let's just quickly understand that middle pillar, critical digital infrastructure. What does that actually mean?
This is basically Amentum addressing the core needs of the modern, hyper-connected world, both for the military and for national security.
Okay.
They're providing solutions for advanced telecom systems, next-gen data centers, and network engineering. This isn't just, commercial IT support. This is about hardening and optimizing infrastructure for maximum resilience and speed.
So they're actually involved in the physical and digital architecture of the data centers that the government relies on.
Absolutely. I mean, think about the need for immediate, totally secure data access in a defense scenario. Amentum is handling the design, the deployment, and the optimization of secure 5G networks for their national security customers.
So they're managing the pipes and the servers, the foundational digital highways.
Yes, ensuring resilience and data integrity in these incredibly demanding environments.
Okay, so if these new markets are only $4 billion today, why should we care so much? It feels like a small lever to move a giant $14 billion company.
It's all about the leverage and the margin targets. The legacy business, it operated at an adjusted EBITDA margin around, 7.7% in fiscal 25?
Okay.
The whole financial payoff of this strategic pivot plus the synergies from the merger is to drive that number toward 8.5 to 9% adjusted EBITDA margins by the end of fiscal year 2028.
A shift of, 1.3 percentage points on a $14 billion revenue base that's massive.
Yeah.
That drops straight to the bottom line.
It does, and the market is starting to reward this disciplined approach. Management's confident that this shift, combined with cost synergies, positions them to drive a projected 12% growth in adjusted EPS for fiscal year 26.
And that EPS growth, that's the clearest signal that this repair and pivot thing is actually working, even before those huge nuclear projects really start to hit the books. Okay, let's move to the heart of the bullish argument then. The strategic moat. The idea that this merger created an entity with knowledge and contracts that make it, virtually indispensable in two key areas.
Yeah.
And those areas are seeing these secular, multi-decade tailwinds: nuclear energy and space infrastructure.
We use that word indispensable pretty lightly sometimes, but in Amentum's case, particularly when you're talking about nuclear infrastructure, the facts are just staggering.
Okay, let's start with nuclear. For Amentum, how big is this business today, and where does their expertise really lie?
It's a substantial force. It's currently about 17% of their total business mix, and it's growing fast.
Yeah.
Their key differentiator is that they play a mission-critical role across the entire nuclear energy life cycle.
What do you mean by full life cycle?
It means they're there from the very beginning to the very end. Their capabilities include the super specialized front-end workflow, design, and licensing of facilities. Then they move through construction management, long-term operations, and critical modernization, extending the life of existing plants, and then finally, the really complex safety commissioning in old sites.
To manage such sensitive, heavily regulated work across that whole cycle, that has to require a technical depth and a safety culture that very few companies can even touch. It sounds like the definition of a high barrier to entry.
It absolutely is, and this is where we drop the mandated fact. Amentum manages roughly 90% of the U.S. Department of Energy's nuclear infrastructure.
90%.
90%. Think about the network of labs, reactors, and these highly sensitive sites all across the country. Amentum is the essential partner. They're the general contractor, making sure those sites operate safely and meet national security requirements. That market share is what cements their role as the essential utility partner in what everyone is now calling the nuclear renaissance.
That sheer scale in the U.S. is it's incredible. But is this a global story?
Oh, it is. Their global footprint is robust. They're active in the U.S., Europe, and Japan, and they have this massive historical depth in the U.K. In fact, they've been involved in every single nuclear power plant ever constructed in the U.K. in its history.
Wow. And that legacy translates directly into current work, I'm assuming?
It does, like the massive cleanup contract at Sellafield.
Right.
The $1.8 billion Sellafield decommissioning contract in the UK is the perfect illustration of their technical moat. Decommissioning a complex nuclear site is infinitely harder than building one.
I can imagine.
It requires unique engineering, robotics, waste handling, regulatory management, things that very few firms have.
Yeah.
And this dual expertise building new plants while safely tearing down the old ones, that's what makes them irreplaceable on a global scale.
So why is this renaissance happening now? What are the big macro drivers, and how does Amentum fit into that?
The drivers are all converging really fast. First, global energy security. Countries moving away from volatile fuel sources. Second, the just fundamental need for reliable 247 baseload power. And third, and this is the most compelling driver, the explosive demand from AI and next-gen manufacturing.
Let's talk about that AI link. Why does AI need Amentum's nuclear expertise?
Data centers consume just a colossal amount of power. I mean, a single large-scale AI data center campus can demand a gigawatt of power.
That's the equivalent of a major city.
It is. And traditional grids, which rely so heavily on intermittent renewables like solar and wind, they just cannot guarantee that kind of dense, consistent power supply.
Right.
Nuclear power, especially the next generation designs, is really the only commercially viable carbon-free solution for that dense baseload power needed to feed the AI beast. This whole situation creates a multi-decade opportunity for sustained double-digit growth for Amentum. They're the engineering firm that bridges that gap between an idea and an operational reality.
So that puts them at this critical nexus of national security and economic infrastructure. But the knock against nuclear is always the timeline. When do we actually see the financial inflection point from all this?
That is the crucial nuance we have to acknowledge. Management is focused on the traditional gigawatt-sized reactors and, maybe more excitingly, the small modular reactor, or SMR, market.
SMRs. Those are the smaller factory-built reactors designed to be deployed faster.
Exactly. And Amentum is working with developers on SMR design, on licensing, improving capabilities right now. But the consensus is that the acceleration into major construction project awards for SMRs, that's going to take time.
How much time?
Likely through the rest of this decade. So for the immediate future, say fiscal 26, fiscal 27, it's all about high-value, high-margin design, planning, and readiness work. The big revenue spike from large-scale construction, that probably starts later in the decade.
Okay, so shifting from critical energy infrastructure to critical launch infrastructure,
Yeah.
Amentum is also a powerhouse in space systems. How is their positioning here different from, say, the large aerospace primes?
They occupy a real sweet spot at the intersection of government and commercial space demands. They're not necessarily building the rockets themselves.
Right.
But they're providing the essential operational backbone, the launch infrastructure, the systems integration, the spaceflight operations that make sure missions get off the ground and actually succeed. They're the operational layer.
Let's highlight some of the big contracts that really solidified this base capability.
The major anchor is the $4 billion U.S. Space Force Range contract. This is absolutely mission-critical launch operations infrastructure.
What does that actually involve?
This involves managing and maintaining the eastern and western ranges. That's the physical and technical infrastructure that ensures the safe and successful launch, tracking, and termination, if necessary, of all military, government, and commercial payloads.
So if you want to launch something from the U.S., you need Amentum.
Pretty much, yeah. And their move into civilian space is just as significant, even if it's a little complicated right now.
That's the NASA story.
That's the NASA story. They were awarded this massive $1.8 billion NASA Cosmos contract. It's a 9-year joint venture for mission operations and systems supporting NASA's deep space exploration programs.
A huge win. It shows they can operate at the highest levels.
It's a massive win. But we have to note the caveat here. The company reported this contract is currently undergoing protest and corrective actions. So what that means is it's not yet secured in their backlog. It demonstrates capability, but not yet immediate revenue certainty.
But the work they are doing today is already historic.
It is. They are deeply involved in preparing for the Artemis II mission, which is scheduled for early 2026. This includes really complex vehicle integration, launch control software development, and the operational mission control systems. They're critical players in getting astronauts back to the moon and, eventually to Mars.
Looking ahead, what are the next big organic opportunities that could drive their space growth, especially as we look into fiscal year 26?
The government is restructuring a lot of its procurement around these large, flexible contract vehicles. And Amentum is engaged in the $150 billion SHIELD procurement.
SHIELD, and that's a multiple award IDIQ vehicle, right?
Exactly. Indefinite delivery, indefinite quantity.
For our listeners, why is getting on an IDIQ so valuable for a government contractor?
An IDIQ contract basically means Amentum has secured a ticket to play. It doesn't guarantee revenue on its own, but it means they've been pre-vetted, they're qualified, and they're positioned to bid on hundreds of billions of dollars in subsequent higher-margin task orders over the next decade.
Without having to recompete for the basic contract every time.
Exactly. And the task orders under SHIELD are anticipated to start impacting the business deeper into fiscal 26. So that suggests this enormous pipeline is just about to open up.
So between the high barrier to entry in nuclear and the indispensable nature of their space contracts, the moat argument is clearly very well supported by the source material. Okay, when a company is executing a complex pivot like this, stitching two massive entities together while chasing these high-growth markets, the most important thing for the market is a rock-solid financial foundation.
Absolutely.
So let's transition to the metrics that define Amentum's financial fortitude. We should start with revenue visibility.
Visibility is probably Amentum's greatest, most immediate strength. It's pretty typical of a top-tier government contractor. They reported a record $47 billion backlog at the end of fiscal year 2025.
$47 billion.
Yeah, and that's the operational measure of estimated future revenues that are guaranteed under contracts they've already signed.
That number is just staggering, especially against their annual revenue. What does that mean in terms of stability?
Well, it provides 3.3 years of revenue visibility. Just calculate that by dividing the $47 billion backlog by the $14.4 billion in annual revenue.
Okay.
And what that means for you, the listener, is that Amentum is just fundamentally insulated from short-term economic shocks or sudden budget cuts in a way that most commercial companies are not. They have over 3 years of guaranteed work already on the books.
And that stability is reinforced by their book-to-bill ratio, right? They're not just burning down that backlog, they're actively growing it.
Correct. Their full-year book-to-bill ratio was strong. It came in at 1.2x. So for every dollar of revenue they recognized, they won $1.20 in new work.
That's a healthy sign.
It is. And the fourth quarter was particularly robust. It hit 1.6x. So that indicates a really healthy win rate and a rapidly expanding pipeline that's just feeding that huge $47 billion backlog.
For a service-based government contractor, I feel like the biggest fear is always losing a massive contract during a recompete. How exposed is Amentum to that risk?
The risk is remarkably low. Management has been very clear on this. Less than 5% of their projected FY26 revenue is even subject to recompete.
Oh, 5%.
Yeah. The vast majority, over 90% of their expected revenue for next year, comes from firm and follow-on work. And that contract certainty is what underpins the conservative and reliable nature of the forward guidance they've issued.
Okay, let's talk about debt. The reverse Morris Trust transaction. It requires the new company to take on significant debt.
It does.
So the deleveraging program that followed is a huge part of this financial story. Where did they start and what did they achieve in FY25?
So right after the merger closed, the company started with a pretty elevated net leverage ratio. It was in the high 3x range, which is actually typical for an RMT that's trying to maximize tax benefits.
Right.
But management immediately made debt reduction a top priority, and they showed real commitment. They achieved $750 million in debt repayments just during fiscal year 2025.
Paying down $750 million in the first year post-merger. That's a substantial commitment. It's a strong vote of confidence in their cash flow generation.
It certainly is. This focus successfully reduced their net debt, and importantly, it lowered that net leverage ratio down to 3.2x by the end of the fiscal year.
And they still have flexibility.
Tons. They did this while maintaining zero near-term maturities and keeping an $850 million revolver completely undrawn. That gives them significant tactical financial flexibility if they need it.
And getting to that magic number sub 3.0x leverage, that's the next big institutional milestone.
Absolutely. The goal remains aggressive deleveraging toward a sub 3.0x target by the end of fiscal 26. For big institutional investors, moving below 3.0x often signals a shift from a highly leveraged profile to a stable industrial one.
And hitting that target de-risks the whole balance sheet.
It does. It lowers interest expense, and it just fundamentally frees up cash flow that can later be directed back to shareholders.
All right, let's talk about that cash flow. Free cash flow is the lifeblood of an asset-light service company like this one. How robust was their FCF generation in FY25?
It was very robust.
Yeah.
Annual free cash flow FCF came in at $516 million. And because they are so asset light, their capital expenditure is tiny, only $27 million.
Okay.
That means most of their $543 million in operating cash flow drops right down to that FCF line. It's a highly, highly efficient cash engine.
And that cash flow is actually guided to grow, even with all the ongoing integration costs.
That's right. For FY26, free cash flow is guided to grow by 12% underlying at the midpoint. It's expected to land in a range of $525 to $575 million.
And what's driving that growth?
It's really a virtuous cycle. It's driven by higher cash earnings from the improving contract mix we talked about and from the lower interest payments that result from the debt reduction.
When analysts look at the current valuation versus that cash generation, they use the free cash flow yield metric to argue that it's undervalued. Can you explain that metric simply?
Sure. The FCF yield is basically the inverse of a PE ratio. It shows you how much cash the company generates relative to its stock price. And using implied valuation metrics, this company is trading at a very attractive 8.5% FCF yield.
What does that mean in context?
To put that in perspective, that's a cash yield you usually see with deep value stocks, not a market leader that has a $47 billion backlog. It just screams that the stock is cheap relative to its ability to generate disposable cash.
And there's a little sweetener, right? A one-time cash benefit coming in fiscal 26.
Yes, that's right. Management is expecting an additional $35 million cash benefit in their FY26 guidance. It's related to the favorable change in U.S. tax law around R&D expensing. That provides a nice immediate boost to their cash generation and strengthens their ability to hit that sub 3.0x leverage target. The financial stability and the strategic alignment, they're powerful arguments, but no deep dive is complete without really critically examining the risks.
Of course.
Amentum stock is trading at a discount for a reason, and that reason is the inherent show-me nature of its current transition.
And the primary risk, as we've kind of touched on, is just the sheer scale of combining legacy Amentum, which had its own culture, with Jacobs' critical mission solutions, which came from a massive public company. Integration on this scale is always a challenge.
You're exactly right. It's not just merging balance sheets. You're merging two large operating cultures, two different compensation structures, two sets of internal systems. Amentum has to prove it can integrate these businesses smoothly without massive operational hiccups or, losing key talent. That's why the market sees it as a show-me story.
So what's the status of this huge integration? Did they get over the first hurdles cleanly?
They're reporting a significant success so far. All the key integration milestones were apparently completed on time and within budget, which is no small feat for a deal this size.
That's a good sign.
A very good sign. And more importantly, they've achieved full separation from Jacobs. All the transition services agreements, the TSAs, those are the contracts that cover shared functions like IT right after a split. Those were all successfully terminated on September 26, 2025. That date signals true independence.
But the real financial reward for all that operational risk is the synergy target. And that's the real test the market is watching, isn't it?
Absolutely. The true measure of the merger's success is the requirement to hit at least $60 million in net run rate synergies by the end of fiscal year 2026. This is going to require continued disciplined execution over the next year, especially in consolidating systems and getting rid of redundant corporate costs.
And if they fail to meet that $60 million target?
It would immediately raise red flags about management's ability to execute. It would put severe pressure on achieving those long-term 9% margin goals. It's a critical number.
Okay, let's talk about the unavoidable risk.
Right.
Customer concentration. This business is built on national security, which means a massive reliance on the U.S. government budget cycle.
That concentration, we're talking 80% or more of their revenue, is the cost of having that moat. It means Amentum is directly exposed to the political volatility of Congress.
Right.
This includes the ever-present threat of government shutdowns or these prolonged continuing resolutions or CRs where agencies are stuck at prior year funding levels. That often prevents new contracts from being awarded or programs from ramping up.
So how transparent is management about factoring that uncertainty into their guidance?
They're being very clear and, I would say, conservative. Their full FY26 guidance explicitly factors in a 1% headwind for potential disruptions.
1%.
1%. And that headwind is specifically quantified as the impact from reduced spending in Q1 on certain programs and from delays in award decisions. That's the direct, real-world consequence of bureaucratic delays.
And there's a timing risk in their internal playbook for next year.
Yes. And this really amplifies the government risk. Management noted that their internal operating plan for 2026 is back-end loaded.
What does that mean?
It means they're counting on a significant amount of execution, new task orders, program ramp-ups to happen in the second half of the fiscal year. So if those early Q1 delays, that 1% headwind, if they persist,
They could have an outsized impact on the annual results.
an outsized nonlinear impact. It makes those later quarters absolutely crucial for them to meet their full-year guidance.
So if Congress has a budget fight that drags into the second quarter, Amentum suddenly has a much shorter runway to catch up.
That is a precise operational risk they are managing. It's going to require flawless execution in the second half of the year to overcome any administrative inertia in the first half. And finally, we have to circle back to the core strategic risk, the pivot itself. The market remembers the old legacy Amentum that was focused on lower margin, commoditized logistics work.
Right.
The entire strategy here relies on successfully pivoting this massive $14 billion portfolio toward higher value engineering and technology solutions.
That sounds like trying to change the DNA of the company.
Yeah.
That kind of shift has to take time to filter through such a huge revenue base.
It does. It's a multi-year effort. And while the new focus areas like nuclear and space are high margin, they still only represent about a quarter of the total business today. It just takes time for new high-margin contract wins to meaningfully lift the margins of the entire enterprise.
And do we have a clear indicator of how quickly that portfolio can change in the near term?
We do. We know that less than 10% of the projected FY26 revenues are expected to come from entirely new contracts. The immediate focus is still on retention and expanding existing contracts.
Okay.
The $20 billion pipeline of new bids they have awaiting decision, that confirms the future potential. But the strategic shift is a marathon, not a sprint. And the market is waiting to see consistent year-over-year margin improvement before it fully buys into the transformation story.
So we've established this duality here. On one hand, a company with financial stability and really impressive strategic alignment in nuclear and space, but on the other, it's burdened by the operational execution risk of massive integration and the external volatility of government funding. So let's synthesize all of this and evaluate the current valuation anomaly.
The initial depressed valuation is really the most compelling piece of the puzzle here. Amentum is a textbook, classic spin-off opportunity because its birth via that reverse Morris trust created this mechanical temporary price pressure on the stock.
Can you explain the RMT mechanics in a bit more detail and how that leads to this pricing anomaly?
Sure. The RMT structure is chosen because it lets the parent company, Jacobs, in this case, get rid of a business line without creating a massive tax bill for itself or its shareholders.
Right, tax-free.
Exactly. But to maintain that tax-free status, Jacobs and its shareholders were required to initially own the majority of the new combined company, somewhere between 58.5% and 63%. And this creates two sources of what we call forced selling.
Okay, source one is Jacobs itself.
Exactly. Jacobs, the parent, planned to sell its retained equity stake within 12 months, which floods the market with shares. And source two is the index funds and passive investors.
How does that work?
Well, many index funds are only mandated to hold, say, the large S&P 500 company, which was Jacobs. When Jacobs spun off Amentum, these funds received shares of the new company, AMTM, that they were simply not mandated or permitted to hold.
So they were forced to sell.
They were forced to liquidate those shares regardless of Amentum's fundamental value.
And this mechanical selling, which is completely detached from the company's fundamentals, creates a temporary valuation dislocation that a fundamental investor can then exploit.
That is the entire thesis. The market is just drowning in this post-spin-off mechanical supply of shares. And if we look at the current metrics, the stock is trading around 12x forward priced earnings, or about 9.76x enterprise value to EBITDA.
How does that stack up against the competition?
When you contrast Amentum with its major high-quality peers in government services and specialized engineering, the discount is just stark. Leidos, LDOS, it trades at a significantly higher 15.75x forward PE.
And Parsons.
Parsons Corporation, PSN, which is very highly valued for its critical infrastructure exposure, trades even higher at 19.46x PE.
So the numbers clearly support the argument that Amentum is trading at a huge valuation gap, roughly a 50% discount to high-quality peers like Leidos and Parsons.
If Amentum executes its integration plan and achieves its margin targets, there is a very clear path for that discount to close, simply by moving its valuation multiples closer to the industry average.
So let's go back to the central question then. Does a 12x forward PE properly value a company that is rapidly becoming the general contractor for the global nuclear and space economy?
Fundamentally, no. The current valuation is pricing in maximum integration and execution risk, and it's giving them basically zero credit for the multi-decade secular tailwinds in nuclear power and space commercialization.
The market is waiting for proof.
Exactly. The proof being consistent, high 90s contract win rates, and of course, successful synergy capture.
What are the specific catalysts then that could force the market to re-rate this stock and drive it toward those peer valuations?
Well, beyond just successful quarterly execution, the major catalyst is a policy shift. The end of the reverse Morris Trust restriction period. Following the transaction, there's a 2-year restriction period related to tax rules that limits how the company can deploy capital.
When does that end?
That restriction period ends after the second half of fiscal year 2026.
And once that constraint is lifted, management is free to pursue capital return.
That is when the strategy can shift fully toward maximizing free cash flow per share. Management has indicated they'll look at returning capital to shareholders. If the stock is still trading below what they see as intrinsic value, which seems likely given the current discount, they will look to share buybacks.
And initiating a robust buyback program would be a very strong signal of confidence to the market.
A very strong signal of maturity and confidence. It would force a reevaluation of the company's implied value.
So, to bring this powerful but complicated story all together, Amentum is really a study in corporate transformation. On one side, you have the immediate high-stakes complexity, the show-me integration challenge, the need to hit that $60 million in synergies, and the perpetual navigation of a volatile U.S. government funding environment.
But on the other side, you have this truly compelling long-term secular alignment. You have organic growth opportunities in global nuclear energy and mission-critical space systems, and it's all supported by these rock-solid financial metrics.
Yeah.
The 3.3 years of revenue visibility from that $47 billion backlog, that provides a defensive floor. And the strong 8.5% FCF yield enables aggressive deleveraging. The current discount is clearly linked to the post-spin-off mechanical selling and the integration fear, and that's masking the quality of the underlying business.
Here's the most critical nugget of knowledge for you, the learner. Amentum represents a low-risk, high-visibility opportunity where the short-term valuation discount appears linked to post-spin-off mechanical selling and integration risk, masking long-term secular alignment with two of the world's most critical and arguably underfunded infrastructure challenges, deep space and essential baseload energy.
And this leads us to our final provocative thought for further exploration. Considering the White House's ongoing push for Generation 3 plus reactors, small modular reactors, microreactors, and the company's existing proprietary role in SMR research and design, how quickly will the explosive, non-negotiable demand from the AI economy, which needs reliable, dense power sources delivered at scale force the transition from high-value engineering feasibility studies into massive, sustained construction project awards for Amentum?
That is the question of the decade for power infrastructure. Thank you for sharing your sources and letting us conduct this deep dive with you. We'll see you next time.